Welcome to the Dough Roller Money Podcast. I'm your host, Rob Berger. Today in episode 311, we're going to be talking about the flywheel. And yes, I'll explain that in just a minute. If you listened to the last podcast, you're probably expecting a show about how to take money out of your IRAs or 401ks, without getting hit with penalties or in the case of a Roth with taxes. That was my plan. I've changed that. I'm going to put that one on hold for a little bit, and I'm going to tell you why. I got spooked this week. That doesn't happen very often in the world of personal finance. It's not that I know it all. I learn something new just about every single day in the world of investing or personal finance. It's when I think I know something and then realize, maybe I didn't know that quite as well as I thought I did. That happened as I was preparing the episode about taking money out of retirement accounts early. I was also editing the chapter in my upcoming book, Retire Before Mom and Dad, on retirement accounts. And I made an assumption that turned out to be incorrect. Let me tell you what it is. As you may know, you can withdraw contributions to a Roth IRA anytime and for any reason without paying taxes or penalties. We all know that, right? It's one of the reasons some suggest, and I don't have a problem with this per se, that you can use a Roth IRA as an emergency fund. I'm not keen on taking money out of retirement accounts for emergencies, but I could see circumstances where you might do that. So that wasn't new to me. What was new to me is that I assumed the same thing was true with a Roth 401k. Now, with any 401k, there is one, well, there are many, but one in particular difference. And that is, depending on the rules of your particular 401k, you may not be able to take any money out while you're still employed with your employer that has the 401k. And I'm not talking about taking a loan, that's a different issue. But you may not be able to simply withdraw money while you're still in service, while you're still working for the employer. But putting that issue aside, let's imagine you've got a Roth 401k, you leave that job, and you decide you're just going to take your contributions out because you assume that just like a Roth IRA, you can take your contributions out anytime without penalty or interest. It turns out it doesn't quite work the same way. And here's how, and here's the difference. Imagine you've got a Roth IRA, and over a number of years you've contributed $50,000, and that the account today is worth $100 because it's grown in value. So you have $50,000 in contributions in a Roth IRA, and $50,000 in, we'll call it earnings. When you withdraw money from that account, the IRS says, we're going to assume that the first dollars you take out were contributions. And only after you've withdrawn all your contributions do we then say, okay, now your $50,001 that you've taken out in our hypothetical is earnings. I should add another caveat. I'm ignoring conversions and rollovers. I'm assuming in this case that your Roth IRA just has contributions and earnings. That's it. You take money out, it's deemed contributions first. Once the amount of your distributions equal how much you've contributed, only then does it come out of earnings, which, depending on your circumstances, could be both taxed and a penalty. I assume that's how a Roth 401k works. It does not. Instead, the IRS does a pro rata basis. So assuming our same hypothetical, but with a 401k, if you had $50,000 of contributions in a Roth 401k and $50,000 worth of earnings, and you left the job and you were going to pull some money out and you thought, I'm only going to take 50 out because that's my contributions and I think those are tax and penalty free since it's a Roth. That's not what they'll do. They'll say, wait a minute, you've got 50% of your total balance is contributions, 50% is earnings. So we're going to, every dollar you take out, we're going to apply that same ratios. For every dollar you take out, 50 cents will be contributions, 50 cents will be earnings and potentially taxed and a penalty added on top of it. That was a big, I didn't realize that moment for me this week. Now, some of you may already be thinking ahead and saying, well, wait a minute, Rob, can't we roll over the Roth 401k into a Roth IRA and then the IRA rules apply and we're good, right? Well, kind of, but then that triggers the issue of the pesky 5-year rule. And at that point I said, I'm going to slow down on this one and I'm going to hit the books And because, by the way, the complexity that I've just thrown at you, and I know we're only 5 minutes into the show. I hope if you're driving, you've been able to stay on the road. This is all mind-numbing in my view. That just scratches the surface. I mean, there's so many different things to talk about when it comes to getting money out of a retirement account or transferring, say, a traditional IRA to a Roth, or rolling over a traditional 401k to a traditional IRA, and then maybe converting some of that to a Roth. I mean, the scenarios get immensely complicated, and the tax ramifications are significant. So I've decided to slow down on that one. The good news is the book doesn't get into all of that detail, because you could write a whole book on this. I just sort of scratched the surface in my book, because the purpose of the book is not to dive into these nuances. But for the podcast, that's exactly what I want to do. And I'm going to need a little more time to make sure I get my facts as correct as this feeble mind is able to get them correct. And the good news is, when I get something wrong, you guys are great because you let me know, and I'm being serious. If I mess something up, I want to hear about it in the Facebook group, doorroller.net/Facebook group, or in an email, dr@doorroller.net. Please let me know, because I will absolutely correct it on the next show in any event. So I'm going to slow down on that one, make sure I've figured everything out, and then I'll be back in a couple of episodes with that topic. So today I want to talk about the flywheel, and I'll tell you what I mean by that in a moment. Before we get to the flywheel, I did want to respond to two listener questions that I received since the last show, and they're related in a way. So let's do that. Two questions from listeners, and then we'll hit the flywheel. All right. The first one comes from a listener named Sam. Hi, Rob. I'm looking to transfer my existing Roth IRA at my bank to a more competitive company like Vanguard, Schwab, or Betterment. I currently have a brokerage account at Schwab and a general investing account at Betterment. I would like to have the option to invest in REIT index funds and other commodities in my Roth for overall portfolio diversification. And unfortunately, Betterment doesn't offer REITs to my knowledge. Should I transfer my existing Roth into Schwab/Vanguard to allow for REITs, or should I go with Betterment to take advantage of their tax-coordinated portfolio offerings? My hesitation with going with Betterment is that the Roth would presumably have the same asset allocation as my general investing account, unless I'm missing something. Also, what are your thoughts on Betterment's smart beta portfolio versus their standard portfolio for both general investing and Roths? For some context, I'm 34. I'm maxing out my my 401k Roth. I think by that he means Roth IRA. Investing $1,000 a month into a taxable account and adding $500 a month to an existing high-yield emergency fund at CIT Bank. No debt except for mortgage, and currently investing about 47% of my gross income. Thank you for sharing your wealth of information on investing and savings. It's been a pleasure listening to your podcast, and it's made me discover that I actually enjoy personal finance and has enabled me to get my affairs in order. Thanks again, Sam. Well, Sam, first of all, congrats. I mean, you're hitting it out of the park. The good news is, as important as the questions are that you're asking, they're not as important as all the other things you're doing, right? I mean, the most important things are you're saving 40% of your gross income, you're maxing out your 401k, your Roth IRA, you're investing beyond that, you're building an emergency fund, all infinitely more important, in my opinion, than whether you invest in a REIT or not, for example. Having said that, still very important questions. I guess the key takeaway, though, is you're doing great, and I don't know, maybe you should start your own podcast, just saying. But congrats, because 47% of your gross income is phenomenal, and you're only 34. I mean, I wish I were that smart when I was 34. Anyway, can't go back in time. So how do we answer these questions? Let's first start and make sure we're all on the same page. A REIT is a real estate investment trust. It's a type of ETF or mutual fund in our case that invests in some form of real estate. It could be apartment buildings. It could be shopping malls. I think they even have REITs that invest in mortgage securities. So it's somehow related to real estate. And for our purposes, it's taxed in a unique way. REITs can effectively avoid tax at the I'll call it the corporate level, at the REIT level, if they distribute, I believe the number is 90% of their income each year. Now, that has a couple of significant ramifications for you and I as investors. The first is it's going to produce a lot of taxable income for us, right? Because think about a corporation that took 90% of its profit and poured it back to its investors in the form of dividends, right? Most companies don't do that. Most companies pay out a dividend. They have a dividend ratio that's much lower than, say, 90 cents for every dollar of profit. But with a REIT, to avoid the tax, to get the tax advantages that are available to REITs, they do distribute 90%, I believe it's 90% of their income each year. So you're getting a lot of taxable income. Plus, because the REITs don't have to pay tax at the REIT level, we have to pay tax as ordinary income. So any income you get from a REIT is taxed as ordinary income, not as dividends or long-term capital gains. So you get hit sort of twice. You get a lot of income coming your way, and it's taxed as ordinary income. So for that reason, you really want to own a REIT, if at all, in a retirement account. Hope that made sense, and I know that wasn't the question Sam asked, but I kind of want to just give you that background. That it's really important. Don't hold a REIT if you can avoid it, unless you've got some unique reason why, or maybe your taxes are really low. I don't know, but I would avoid owning a REIT in a taxable account. Okay, so what should he do? Should he? First of all, I think it's an excellent idea to move your account away from a bank. Generally, and generally there may be some exceptions out there, but generally that's not the place to hold it. So should you go with Betterment and not have a REIT? Or should you go with Schwab Vanguard and have access to a REIT? So the first thing is, one, you are correct that the Betterment's core portfolio does not include a REIT ETF. Now, its portfolio as a whole does have exposure to real estate, and even REITs, I think, right? Because when you own an index, depending on which index you own, one, I think there are going to be REITs in that index. And if you're watching the YouTube video, you see me looking up at the ceiling of my office as I think. I'm pretty sure that's true. But also, just companies in general, depending on the company, are going to have exposure to real estate holdings. So you still get some real estate exposure, even say in an S&P 500 index fund. But I do get the idea that maybe you want to increase the allocation of your portfolio to REITs more specifically. And so I get that, but I just kind of want to point that out. Yes, I think you're right. Betterment's core portfolio doesn't include a REIT ETF, but you're still going to have exposure to real estate. However, you asked about their smart beta portfolio, and I've not invested in their smart beta portfolio. Actually, I don't have an account at Betterment anymore. I did for a while. By the way, no reason why I don't. It's just that, I don't know, I'm old school, so I stick with Vanguard. But their smart beta portfolio does include a REIT ETF. So if you want to go the smart beta portfolio route with Betterment, you would have a REIT ETF in that portfolio, at least as of the research I did preparing for this podcast. That leads to one of your other questions, though. What do I think about Betterment's smart beta portfolio, and really smart beta in general? I'm not a big fan of smart beta, and I don't like the complexity. I generally don't like the fees, although that may not be as much of an issue for Betterment. I generally don't like the fees. There's a couple of reasons for that. So let's first start with what smart beta is. Imagine if someone said, look, you invest in the S&P 500 index, right? Yes. What if we could pick and choose, rather than investing in the whole thing, you could pick a different index, but rather than investing in the whole thing, let's figure out a way to slice and dice it so we can just take the good stuff and leave the not so good stuff for someone else. Okay, I mean, in theory, that sounds great, right? But then the question becomes, well, how do I figure out what the good stuff is? And different smart beta portfolios try to answer that in different ways, right? They may look at value, they may look at momentum. And if you want to research Betterment's approach, which I think they use a Goldman Sachs smart beta, but in any event, you can just Google Betterment's smart beta portfolio and they'll give you all the details. In and of itself, I don't have a problem with that, but there are, I think, two issues. Apart from potential one being cost, but beyond that, I think there are two issues. The first is this. when you invest in something outside just a passive index portfolio, and in this case, smart beta, risk parity is another one. It's different, but you may have run across that as well. Eventually, at some point, smart beta will underperform the market. And it could underperform the market significantly. It could underperform the market for an extended period of time. Now, those that champion smart beta say they would agree with that. I think if you're a smart beta person, if that's how you invest, you would probably agree with what I just said. Your response, though, would be, but over the long term, a well-constructed smart beta portfolio should outperform the market over the long term. It may underperform and may even underperform significantly in shorter periods of time, but the long term, it should outperform. So the problem with that, twofold. One, we don't know that it will, right? More importantly, how are you going to handle the months and years when it underperforms? If you stick with, say, Betterment's smart beta portfolio, I suspect over the long term, you'll do just fine. Will it outperform an index passive approach? Time will tell, but my hunch is you'd probably do fine. The key question is, can you stick with it? Can you say, you know what, I'm smart beta and I'm sticking with it for the next 40 years? If you can't, then I don't think it's the right strategy for you. That, to me, consistency is the real question. And it's one of the reasons that the majority of my investments, our investments, not all of them, but the majority of them are in passive index funds, because I am confident that I can stick with that approach even when we encounter another, 2008, 2009. I stuck with it then. I hope I stick with it when we encounter the next one, and we will. I'm not sure I could stick to a smart beta. I would start to have questions. Well, wait a minute, is this smart beta as smart as it claims to be? Maybe smart beta is okay, but what about this one? The Betterment smart beta, or the whatever, fill in your blank smart beta approach. Maybe they mess something up. That's my concern. So that's the first thing. The second thing kind of relates to cost, but there is, in the world of investing, there are folks that almost are drawn to complexity. It's like they just can't help themselves. It's like I just can't, I can't stick with a simple index fund strategy. I need some excitement in my life. And so they come up with smart beta and risk parity. They come up with really complex passive index fund investing, where you've got 15 different asset classes. I've got a good friend who's got this massive spreadsheet. He shares it with me periodically, and he slices and dices this thing in a million different ways and has all of these, he has a China ETF. I mean, he just breaks it all down by geography and size and value and growth. At the end of the day, if you just mix it all together, it's probably not much different, in my view, than buying a couple of funds that cover the whole world. But it scratches an itch for him, you know what I mean? And that's just what he needs to feel good about his investments. But it's not very expensive, and it's still, at the end of the day, an index fund. But with smart beta, I worry that people are just sort of searching for complexity to satisfy some hunger that I'm not sure in the long term will be in their best interest. As an example, I was talking to a friend of mine who is a financial advisor, and he charges, 1.5% of assets under management, and he knows how I feel about that. And he puts his clients in actively managed mutual funds that also charge 1.5%. And we debate that. And I tell him, you realize there ain't no way in the world your clients are ever going to outperform a simple index strategy. And we go back and forth on that. And I'm a bit cynical, because what I think is those advisors that are charging 1.5%, most of them won't put you in a simple 2, 3, 4, 5 fund index approach. Why? Because they haven't earned their value. What's complicated about that? Why would you pay someone 1 or 1.5% to stick your money in 3 index funds, right? So they come up with these complex strategies, complex asset allocations with mutual funds with weird names to them, like smart beta and risk parity, justify their 1.5%, charge you the extra 1.5% on the funds they're putting you in, And in the long run, you're going to be worse off. I guess that's how I feel about smart beta. It's like a solution in search of a problem. I just don't get the why. I still don't think we need it. So no, I'm not a big fan of smart beta. By the way, Wealthfront's doing the same thing, and I think it's for the same reason. It's like what they need to do from a marketing perspective. Okay. I don't know that's true. Maybe the founders of Wealthfront and Betterment truly believe in smart beta and believe it's the absolute way you should invest. I just don't. Okay. One last question that Sam mentioned was, he goes, my hesitation with going to Betterment is that the Roth would presumably have the same asset allocation as my general investing account. I don't think that's true for at least two reasons. One is you could change the stock bond allocation if you wanted to, right, between the two. But you mentioned Betterment's tax coordinated portfolio, which is, I assume, what you would use. I looked that up, and according to Betterment, the allocation is not the same. They put, and I'll just read it, it says, it starts by placing your assets that will be taxed highly in your IRAs, which have big tax breaks. Then it places your lower taxed assets in your taxable accounts. So I'm assuming what they mean by that is that bond funds, since they don't have a REIT fund in their core portfolio, that bond funds go into the IRAs. But in any event, I don't think you should assume that the portfolio will be identical at Betterment if you're using their tax coordinated portfolio to optimize the asset location. Of course, to be sure, you're going to want to reach out to Betterment. They have all of the answers. So have I covered everything? This is a good email, Sam. A lot going on there. At the end of the day, for me, I would put my money in Vanguard just because that's where I put my money. I like Betterment a lot. I don't have any problem with Betterment. And if you wanted to use Betterment, I think that's great. I wouldn't use Smart Beta. I would just put it in their tax-optimized, tax-coordinated account. That's what I would do if I were going to use Betterment. So there you go. Thanks for the email. Next question, kind of related, talks about REITs anyway, comes from Russ. Love your podcast. Quick question. Take a traditional portfolio, say 70% stocks, 30% bonds. Where do you assign other, he puts it in quotes, defensive holdings like TIPS or REITs? Would you attribute these assets to the 30% bond allocation since they are likewise defensive in nature, even though they are not technically bonds? Thanks for all the wonderful advice, Russ. Well, it's a great question. First of all, I'm not sure why you say TIPS aren't bonds. TIPS are Treasury inflation-protected securities issued by our government. They're bonds. So TIPS are bonds, and they're, in terms of defensive, I guess you could call them defensive. They're certainly not volatile, right? There's not huge price swings. We all know as interest rates go up, the value of existing bonds go down, right? Now TIPS, though, are different, right? They are inflation protected, so they have a feature where the rates can actually go up when inflation rises, inflation and interest rates rise. But TIPS are, I would put TIPS in the bond allocation. That's what they are. REITs, on the other hand, I would put in the stock allocation. REITs are, think of it this way, if you own a REIT that invests in malls, you're part owner. You're in effect an owner of the mall, kind of, right? In other words, you're not just getting paid based on a fixed interest rate because the securities you own inside that REIT are lending money to someone and getting a fixed interest rate back. You're an owner, you're getting profit from the enterprise. Now, there are mortgage REITs, so I suppose depending on the REIT, you might look at it, it might function more like a bond. REITs are a bit unique in that way. But having said that, I don't think of it at that level. I just dump REITs into stocks. I think that's the right way to go, particularly when you look at the volatility of REITs and the expected return of REITs. They act and look more like stocks than bonds. And I would say the same thing of commodities. Now, again, that's where you need to look under the hood. Some commodity funds, and you didn't mention commodities specifically, but I'll talk about them because sometimes they can be tricky as to where you should put them. Some commodity mutual funds and ETFs invest in the actual commodity. You actually own gold and wheat and oil or whatever. Others invest in companies whose performance is heavily dependent on the price of commodities. There you can think of an oil company, a mining company, something like that. So clearly in the case of an ETF, a commodities ETF that owns companies, you'd put that with stocks. But even if they own the actual commodities, I still put them with the stock allocation because of their volatility and expected returns. I don't personally invest in a commodities fund, but I do invest in REIT funds. And for both of those, if I were going to have a 70-30 stock bond allocation, I would figure out how much to put in, but the REITs and commodities would take up part of the stock allocation. And I would leave the 30% bonds for bonds, including tips. So there you go. Hope that helps for us. Thanks for the email. All right, on to the flywheel. What the heck is a flywheel? So this came up, I was listening to a great podcast, highly recommend it. It was an interview, it was Tim Ferriss's podcast, and he was interviewing Jim Collins, who wrote Good to Great. You may have read his books. Well-known author, thinker of, he's a researcher, looks into, what makes a company successful. How do you distinguish between companies that are successful and those that aren't? He talks about the concept of a flywheel, and he's even published recently a monograph, sort of a short book on Amazon about this concept of a flywheel. So I'm going to explain what a flywheel is, but for you engineers out there, recognize and please appreciate the fact that I have a degree in English, not in engineering. So feel free to email me and tell me everything I got wrong, but here we go. And this is my simple understanding. Flywheels are wheels that they don't like to change, is effectively what they are. If they're not moving, they don't want to move. And if they're moving, they don't want to stop. They're really hard to get moving, but once you get them going, they're easy to kind of maintain. I think of a spin class, the bikes they have for a spin class. If you've ever taken a spin class, kind of hard to get going, but then once you're moving, the thing just flies. And if you've ever tried to stop one of those things with your feet, with your legs, it's a good way to hurt yourself because that wheel does not want to stop, right? The right way to stop it is with that red knob where you turn right to make it harder to pedal and left to make it easier to pedal, or you just push it straight down and that actually stops the wheel. That's a flywheel. Now, by the way, I don't know if in spin class the bikes they use are actually flywheels. That's where you engineering folks can maybe help me out, drdoerler.net. But you get the idea. And Jim Collins uses this in a couple of different ways to talk about successful companies and the like. I want to use it to talk about investing because I think it can be used to really understand an important concept about investing. And to do that, I want to actually read to you a small portion of a chapter of my book that never made it into the final copy. So this is, if you're kind enough to buy the book when it comes out, you will not see this. You'll see the concept, but not this. And it was part of a chapter that I called the 9-year rule of compounding magic. So it's just a couple of paragraphs. It's real short. Let me indulge me. Let me read this to you. So I've convinced you to start saving and investing today. Excellent. So let's imagine you give up cable TV to save more money. You take the $100 monthly cable fee and invest it in a low-cost index mutual fund. You feel good about your decision, although you missed some of the shows you used to watch on TV. Now let's fast forward 1 month. You've suffered through withdrawals from the lack of cable. You've yelled at your kids a bit more than usual. Surly would best describe your I gave up cable to invest mood. To ease your pain, you decide to check in on your investments. You log into your account, and if we assume the month was a typical month for the stock and bond market, you earn, say, 8% divided by 12, or 0.67%. Your $100 investment has turned into the princely sum of $100.67. At this point, several things happen. First, you curse me in the day you ever bought this stupid book. Second, you kick yourself for giving up a month of Property Brothers for a lousy 67 cents. And you're at a loss on how to respond to your significant other who went through his or her own cable TV withdrawals and wants to know how the investment is performing. Welcome to the world of investing. Yeah, it starts off really, really slow. And that brings me to what I call the 9-year rule of compounding magic. All right, so I'm done reading from that chapter. The point, and if you guys have invested, if you're an investor, you know what I'm talking about. If you're still on the fence and you haven't started yet, you need to be prepared. it starts off really slow. It's just like a flywheel. It's hard to get that thing turning. And you invest your $100, your $500, your $1,000. It doesn't matter what the amount is. And it doesn't seem like anything's happening. In fact, depending on when you invest, you could end up your first month or your first year with less money than you invested, right? That happened to me actually. When I was investing in the 90s, I just gotten out of law school, started a job, had to wait a year to open up a 401k. And I remember a colleague of mine, we were laughing. It was like, we put our money in each paycheck, and by the time the next paycheck comes around, our account has gone down by the amount of our last contribution. It was like we were just filling a hole every paycheck. That's the nature of the beast. And I think we do ourselves a great disservice if we don't understand that going in. If we understand that going in, we set the right expectations for ourselves. It's true in a lot more than just investing, but it's certainly true with investing. And I want to mention this 9-year rule of compounding magic, as I like to call it. How does that work? What I have found, of course, this is going to depend on the rate of return you get. But if we take a typical rate of return, 8 or 9%, somewhere in that range, it's going to take you 9 years of investing the same amount of money each month. Doesn't matter what the amount is, but we'll just use $100 as an example. It's going to take you 9 years before that investment gets to a point where it produces $100 of a month in returns. 9 years. If you're investing $1,000 a month, it's going to take about 9 years for that investment to grow to a point where it can produce roughly $1,000 a month in investing. Doesn't matter the amount. 9 years before it's going to produce on a monthly basis the same amount that you're investing. And when I say produces, I mean from dividends, from your stocks, from the stock funds, interest from your bond funds, appreciation as the value of these things go up. Again, using a typical, say, 8 or 9% return. It's 9 years. Now, what's interesting about it, I mentioned though, that's the hump you have to get over. That's the time when the flywheel is really difficult to get moving. But there's good news, right? Once it starts to spin, man, it starts to really move, and it gets easier and easier and easier. So how do we look at that in terms of investing? Well, it's 9 years. Again, I'm just going to use $100 as an example. It takes 9 years of investing $100 a month before your investments are growing by roughly $100 a month. How long does it take to go to $200 a month? How long does it take? You spent 9 years to get to where your investments will produce roughly $100 in growth each month. How much more time does it take before you get to $200 a month in growth? Again, still just contributing your initial $100 a month. It just takes 5 more years. It took 9 years to get to $100. It takes just 5 more to go from $100 to $200. And at that point, it just takes about 3.5 years to get to $300. 2.7 years, I got rather specific, 2.7 years to get to $400 a month. 2.3 years to get to $500 a month. 1.9 years to get to $600 a month. You see how it gets faster and faster and faster and faster. That's the flywheel in action. Once you get the compounding rolling, it takes over. Eventually, it's the compounding that's growing your wealth far more than anything you and I could contribute. I mean, the contributions are important, right? That's what gets that flywheel turning to begin with when it doesn't want to budge, right? But eventually, it's the compounding that's growing your wealth. And in fact, when you look at long periods, say 20 years of investing or more, the amount of wealth you'll accumulate, the vast majority of it will not come from your contributions, right? They will come from compounding, from growth, from the dividends, the interest, the growth and value of your investments. And the numbers get really big. I mean, if you invest over, say, a typical 45-year working time period, say from your early 20s till your mid to late 60s, I would say more than 90% of your wealth at that point, your invested wealth, 401ks, IRAs, taxable accounts, will come from compounding. That's the flywheel. So I think if we understand that, if we have that expectation, yeah, it's really slow to begin with, but if you stick with it, it'll take on a life of its own, and it'll almost be, it'll just start to run on its own. At some point, you could even stop your contributions if you wanted to, and just let the flywheel take over. So that's the idea. I think it's an important one. Now, not everyone has that patience, right? Those first 9 years are no fun, let's be honest. And a lot of folks try to take shortcuts, in my opinion. How do they do that? Well, I guess I could say they invest in a smart beta portfolio, but I don't know, that might not be fair. Could be true, or risk parity. Penny stocks, that's one way to take a shortcut, right? May not get you where you want to go. Day trading, that's another way folks do it. Options trading, and again, I don't mean to suggest that all options trading is bad, but I have good friends who are big option traders, and I tell them, I don't think this is a way for you to make money. I think you'll do better if you just stick your money in an index fund. They don't listen to me. Individual stocks. I have no problem with investing in individual stocks. I own individual stocks. In fact, let me tell you a quick sidebar here for a moment. I've always had this theory that if I took all of the cashback rewards I earn from credit cards and invested, it would turn into a pile of cash. And I could use it as a teaching tool to say, look, even taking your 2%, I use the Citi Double Cash card, even taking 2% from the Citi Double Cash card, which is what it pays out in cash back once you pay off the bill, and investing it could over your life easily be 6 figures in wealth. So I thought, and I've wanted to do this for a while, I thought, I'm going to actually start doing that. So in fact, it was just a week ago, I had about $500 in cash back sitting in the account at Citi, and I had them send me a direct deposit, and I had some other cash back from previous times. Long story short, I had almost $3,000 in cash back. It's like $2,700, and I invested it in Berkshire Hathaway stock. So there's an individual stock for you. And what I'm going to do going forward is each time I build up enough, I don't know what the number will be, but a couple $100 in cash back, I'm going to get it sent to my account, transfer it to Vanguard, and buy Berkshire Hathaway. And then my hope is, I don't know, 10 years from now on the podcast, will we all still be here? Will I still be doing this 10 years from now? I don't know. I can say, you know what, it's up to $87,000. Wow, look at that. And hopefully encourage some people to invest. So I don't have a problem with individual stocks, but I think for some folks, it can be more of a distraction and an attempt to take a shortcut to wealth. The fourth one, playing the lottery, right? Not exactly investing. I don't think any of us, I hope none of us would call that investing. But there's actually, if you Google how to win the lottery, I mean, there are systems that people sell, and that actually doesn't surprise me. What surprises me, there are systems that people actually buy. And there was one guy who apparently has been playing the lottery for every day for 25 years. Every day, 25 years. And he won one jackpot. I think his biggest one was $98,000, which you may say, well, that's, maybe for him it worked out, but of course it didn't, right? So I went to portfoliovisualizer.com, and I back tested a portfolio 25-year period, and I assumed $5 a day in lottery. It didn't say actually how much he's invested. Listen to me. How much he's gambled. That's what he's doing. How much he's gambled each day. But I assume $5. In a 100% U.S. stock market portfolio, he would have 200 grand, 195,000. If we went with a 70-30 portfolio, 30% in total U.S. bond market, he would have 172,000. Now, that's assuming $5 a day. I get the sense it was more than that. So if we move it to $10 a day, let's see if I can reset this. Here we go. 390,000. That's what you'd have if it was all in a U.S. stock fund. 345 if it was a 70-30. Not only that, but the taxes would be better, right? Because how are lottery winnings taxed? Ordinary income, right? The growth on this would be long-term capital gains, and there would be some dividends for sure. They may be qualified. It depends, right? The 70-30 portfolio would have some interest, but still, by far, the tax consequence is much better in these investments than through lottery winnings. So anyway, just one example, another example of how people are taking shortcuts. Don't take shortcuts. I mean, if you want to take some portion of your portfolio, 10%, 5%, and invest in individual stocks, do it, if that's what you want to do. I'm not here to tell you otherwise, but I am here to say you need to understand the flywheel. You need to understand that investing takes time. You need to be patient, and at a minimum, be very concerned when you start to have that itch to take a shortcut. Whether it's penny stock investing, day trading, options trading, well, I'm sure playing the lottery for fun is one thing, but none of you are doing it like, as an investment, I assume. All right. One last thing I want to talk about flywheels today is that they apply outside of investing. I think about it a lot when I think about the online business I built over 10 years. It was very much a flywheel in action, where you start building a website and no one visits it. I mean, absolutely no one. You're publishing all of this content. I mean, this was all before the podcast, right? The podcast started in 2013, but I started blogging in 2007. I'm sure none of you in 2007 had heard of Door Roller and were reading the content, because no one was reading the content. I was working my butt off for nothing. I wasn't making any money. No one was reading the content. It was miserable. But I stuck to it. And what I learned over time is that the more you do it, and as long as you got to stick with it, it gets easier, right? And in many ways, the online business is a war of attrition. Your goal is to stick with it and outlast all the other folks. I mean, I come across countless blogs where you'll see their last article was 2015, 2012. I mean, they just gave up. And there may be good reasons for them to do that. Each person has to make their own choices. But this idea that when we start certain things, it's much harder, and then over time it gets easier, can apply to our business and our careers. If you're a real estate agent, when you start out, it's hard. You don't know anyone, you don't have a network, you don't have clients that can refer you new clients. But fast forward 10 years, and you've sold a lot of real estate for folks, and you've met a lot of people. People are referring you business. You've got a network of folks. It gets much, much easier. I found that to be true in the practice of law. A lot of my clients came from older clients that I'd helped, in the past. It's true in a lot of different industries and markets. It's even true if you think of just sort of just being an employee. Maybe you don't have your own business. You're not a lawyer trying to build your own practice, or a real estate agent, trying to build a portfolio of clients. You're an employee, whatever your occupation might be. When you start out, things are tough. You've got a lot to learn. But over time, it gets easier, hopefully. And that's really the big takeaway from today's show. Don't give up. Recognize that the beginnings, certainly true with investing, I think it's certainly true in business, are slow and can be difficult. Expect that, right? Don't be surprised by it. Expect it. That's the way it is. But also know that if you keep at it and you keep doing good things and you shun the shortcuts that can tempt us, things will get easier. The flywheel will start spinning. It'll get easier to spin, and you'll make progress. Hope that makes sense. And if it doesn't, well, there you go. It's the best I got for today. Please keep your emails coming in, dr@doorroller.net. Would love to hear from you what you think of the show. Also, questions that you may have that I can cover in future podcasts. I will not forget the podcast on retirement accounts, and specifically taking money out early. I will cover that. I just want to make sure I cross my T's and dot my I's and get it right before I record that podcast. So that will be coming in the not too distant future. Hey, hope you have a great week. Until next time, remember, the best thing money can buy is financial freedom.